Welcome back to my channel, Balance Sheets Matter. It's been quite a while since I did my last video, but thought I would start doing some videos again. And to start that off, I think it would be good to do some updated stock analyses, giving updates on some previous stocks I've done analysis on. So in this video, I'm going to be looking at Smuckers SJM, Charter Communications, CHTR, and SBUX, SBUX. So I'm not going to play these videos. I do suggest maybe go watch them after you've seen this video so you can see what I'm talking about. But I'm just going to highlight a few key things that I said in the videos about the analysis and, see if I was on point or not, or if there's some improvement I could have had in some areas. So we're going to start with SJM. When I did the video, it was about here. And you can see it has continued the trend down a little bit. But you also do have to factor in that, while it has trended down a little bit, you have almost received $9 in dividends as well. So that does dampen the blow a little bit to how much it is down there. And one of the things I did say in the video about SJM here was that this is not a stock that is going to outperform in a bull market. This is a defensive stock that you are really buying and planning for a bear market, which maybe in my portfolio I've been positioning a little bit too early. But if you bring up like the S&P 500 here, you can see the S&P 500 has been going up. SJM has been slowly trickling down. And I think this gives a lot of the same vibes as 2000 bubble here. Not saying exactly the same, just a little bit of rhyming going on, where SJM was getting hammered into the very top of the bubble, and then these things inversed here. So the whole purpose of buying SJM, which I did, and I am actually planning on buying some more, was to prepare if there is a bear market and have this as one of these defensive stocks to kind of counter that downtrend in the overall market. So let's jump into their financials here. And we're going to start basically on the income statement, because one of the big things I look at is the margins. Maybe I should, really call my channel Margin Trends Matter, but, I thought, Balance Sheets Matter was kind of catchy. So the one thing is I'm always looking if there's deteriorations in the margins, since that can mean the company is losing its moat. And we have had a little bit of a tick down in the recent 12 months, but you can see in the quarterly here, this is just because of one off quarter. And if we look at all the quarters here, this isn't a normal quarter in July, the quarter ending in July, to have a really big off quarter. And these other quarters actually do seem relatively good. And if we do look at past ones, we had 33.56 gross margins here. There's been quite a few times we've been around that too. So I am not seeing any significant deterioration in basically the gross margins here. So I think the company still is overall in a good fundamental place from that perspective. And you can also see the net income has been continuing to grow as well. One of the things I also did mention in the video is they did do a big acquisition, and there's a lot of implications around this, of that you kind of have to judge companies like this based on their ability to do acquisitions. And in the past, they never really had that many big write-downs from their acquisitions. And you can see the big red numbers here under the other income expense is they actually have done a lot of write-downs in the last year. And that probably is part of the reason why the stock has trended down a little more than normal. But considering the level of the write-downs, the amount it's down really isn't that much, which may say something about its value. But also the thing is the the market, the economy, the consumer packaged good market, especially all the related stocks have just been absolutely getting hammered in this industry, that just because they are writing it down now doesn't mean that really that value and that potential to grow on the top line and drive profits in the future is gone forever. So the next thing is the implication of this acquisition is their interest expense would go up. And you can see it has ticked up as expected. But what would happen because of that I did say in the video, is I said they would probably stop their buybacks and they would start paying down the debt. So if we go down into their balance sheet here, let's look at their total long-term debt here. And when I did the video, it was not at a completely fiscal year end, and they had $8.1 billion of debt, and they have managed to pay that down to $6.8 billion. So they have been doing some, good effort on doing that. And if you do look in the cash flow statement here, you can see the repurchase of stock basically has stopped. So what I was saying was expected. It basically has completely played out as expected. We don't have the buybacks happening right now. That's not giving support to the stock price, and they are doing the financially responsible thing of paying down the debt. So that is good for a long term perspective. So let's look at the valuation a little bit now. I'm just going to pop into my interactive chart, as I always like to do. And let's pop up the price to sales ratio. And you can see when I was originally talking about it, I think it was, around back here, we were at a relatively low level, but for the price to sales, considering the margins, but there always was more room to go down. And that is what's happened a bit. I'm just going to bring up the net margin here as well. And this is because of the write-downs. It's so significantly down. And you can see these margins now, we probably are somewhat stabilized at this future level here. So considering that, there always was potentially more downside for the stock. And if we go to the chart here, this is one of these ones that I was looking at that I only did get a relatively smaller position that I was planning on effectively buying the dip if it got cheaper. And I think I did say that it could effectively, chop sideways while for a year plus before really it took off. And there was no rushing into this stock. So this is one of these stocks that I always viewed as you want to go and buy it on the dips and get in defensively as a defensive position in case there is a big bear market to potentially hedge yourself, because when the bear markets hit, like in 2022, it runs up and then you can sell them and have a lot of money to buy, tech stocks or whatever else when all the other stocks are at their lows. But how things are looking right now, it looks like it could go a little bit further down. If we look at weekly here, you kind of really don't want to just buy into these nice falls. You do want to wait till there's a little bit of support like these areas. So that is personally what I'm waiting for to start occurring, is wherever this happens to basically start basing a little bit for a couple weeks. That's when I'm really planning on buying in and actually building out that full position. And then we're going to see how that performs in the future. So I think overall, my analysis I did was relatively on point. This was not a stock I was expecting to go straight up. It kind of has played out as expected. And the negative did happen is that they did do a big write-off on their acquisitions. And considering that, the amount they're down, I think they've actually done relatively well. So this is still kind of a to be decided if this was actually a good stock pick or not. This is going to take actually probably a few more years to really see if it does play out, because maybe it goes down and starts going something like that. But you can see even just my scribbles here, this could take potentially a couple years to even really see that fully play out. Okay, so the next one, we are going to go into Charter Communications. So I had previously done a very brief update video on it before, and I think it was the ACP subsidies basically went away, and that caused a little bit of contraction for them. As you can see, I have this is when I did my last video on it here. It popped up actually to a pretty good price at 435, and it has had some headwinds and effectively come down again. So let's check out how it's looking in the financials here, because right now the stock is getting very cheap, and it has a PE of 6 and a forward PE of 4.93. And if we look at the financials here, let's pop in and look at the revenue trends. And the big problem was when they lost these customers with the government subsidies, it kind of really did create a minor contraction in their revenue. And you can see they've been effectively since 2022, the revenue's been flat. The one thing I really do like to see that I think actually is really good for Charter Communication is their gross margin is growing. So while this company may not have a lot of growth going on in the future, they do have effectively are showing a good kind of competitive mode, even though it actually is a kind of competitive industry with Comcast and other providers there, that they are able to get their gross margin a lot higher. And the selling basically in general admin, that's come up a little bit. So that's being countered a little bit by the gross margin. When we add in all the operating expenses, the operating margins still actually are at the highest levels they've ever been. And interestingly enough, too, the interest expense has taken down a little bit. And I did do a little bit of examination in their whole debt profile here. And in the next few years, there's only a very small amount of bonds that are actually maturing. And the amount, if they had to renew it at the higher interest rates, would really possibly only up their interest 1% or so. So it's almost a non-negligible issue. So while they do have a high interest expense, it's going to be a very stable one, and I think their profits are going to be stable going on in the future as well. As you can see, the operating income here has actually grown a little bit, not very much, and that may be what the trend is basically going forward, because I guess the inflationary pressures and this and that, competition, they haven't been able to raise prices as much, along with cord cutting because of Netflix. But you think, oh, if Netflix is going to raise their prices, which they've been doing, there actually may be less cord cutting in the future. And when you look at what these companies do, they kind of have the overall infrastructure for the cables for the internet there, so they do have a solid base. It's just only certain parts of their business which were under pressure recently. But going forward, this is not going to be a high growth company, and they really do buy back a lot of shares. As you can see, they have continued the buyback since I've done my last video here. And there's not a lot of changes on the balance sheet, but let's just go into the cash flow statement here, and you can see that they are continuing to buy back a lot of stock, and they do have the cash flow to support this. It might not be at this current level they did of 5 billion in the next year, but their free cash flow is usually between $3 to $5 billion. So somewhere in that range, they should be able to continue the buybacks. The one thing to note that has updated a little bit is their CapEx has marginally gone up a little bit. Before, they were at this more maintenance level where their cash flow from depreciation was around 8-9 billion, and they were basically matching because they do have to do new infrastructure. It has gone up a little bit. So you do have to factor that in a little bit too. That's, I think, a short-term headwind. Once they build out again like they have in the past, we should see it possibly tick down a little bit. So fundamentally, I don't think this company is going anywhere. I think it really just comes down to the price. And probably what I did wrong in the past is I was garnering it maybe a little bit too high of a P ratio, because when you look at a stock that's not really expected to have any revenue growth, let's bring up the revenue trends, you see it's completely flat. And whether they're going to be returning the cap to you with a dividend or a buyback, the company just does not garner a very high P ratio. If you look at something like HP, they typically trade between a 5 and a 15. And maybe that's more like what Charter is going to do. But now at this 5-6 PE ratio, I do think they actually are very, very cheap. And I am planning on, building my position out a lot more. And you can see actually that even though the revenue is flat, their EPS is expected to go quite aggressively, because they can do these buybacks and they can buy back very large amounts of the company. We go back here and look at the market cap. The market cap is only $27 billion right now, and they can probably fairly conservatively do $4 billion of buybacks per year. So the next one we'll go into is we're going to go into Starbucks. And Starbucks Corporation here. I originally did the video. Oops, still need to scribble over the chart right here. And the key thing I said about Starbucks at this point was, let's go into their financials here, is if you watch my video in the past there, I said I was planning it on buying it if it dropped at lower prices, and I actually did do some fairly significant actually buying in the 70s here. But I did really highlight that you really need to watch the gross margins, because when I did the video, it was more this time here, and I was saying that if they start even dropping to 26, 25, that's when I would start getting worried and reevaluate. And if you see here now, they dropped the 26.84 and then 22.77, and What's also happened? Well, the operating margin has got smacked down as well. Before they were maintaining mid-teens. Now it's basically below 10%. And on top of that, this revenue trend. In the previous video, the analysts were expecting a much more aggressive growth in revenue trend, and that has not occurred. The revenue has been very slow, and you can see they're getting squeezed by the gross margins. These are not good signs for the company. And when I started seeing this, this is one of the reasons I actually decided to exit the stock. I forget the exact moment. I think it was around $90, but I think I exited somewhere right around here because at that point in these 2025s here, I really got to see how much the margins were hammered and the revenue was slowing down. And I said, this no longer fits my old previous analysis anymore. And when I start seeing this out of stocks that have lost this like really long-term fundamental gross margin trend, start getting slowing down revenue and really declining gross margins, which usually leak down to the operating margins and the net margins, this is when I become not interested in the stock. So while at the time I was saying, oh, I think this is a buy based on these assumptions and what analysts are saying, my main key thing was as soon as those margins drop, if they maintain, great, there's a good upside for it. But if they do drop, that is very worrying. Also, Starbucks has been a stock that did historically trade at a higher PE. And in my past video, I was talking that, oh, maybe a 27 or a 30 in the historical range there. But now with these growth numbers and this margin compression, this company should not garner such a high PE. So I actually think that, well, in the short term, you can't predict the future. I can't predict what their gross margins are going to be. And the stock is relatively about the same price that I actually originally, sold it at. I think there is very limited potentially upside in Starbucks, and there is a lot of risk for it. Well, things, could potentially just range sideways. There is this big possibility that it really drops down. So I think my initial analysis I was fairly on point on some things. I might have been a little bit looking too optimistic, but those obviously did come with the caveats that if the gross margins do start dropping, I'm going to get out of the stock. And I was actually able to do that and make a little profit along the way. So when I did the video, the stock has effectively gone sideways. I did manage to get out of it and make a little profit. And again, at this point right now, I wouldn't buy it. I would, greatly actually be expecting that, they could fall a bit. You can see in my little channel here, this overall trend, and we see this big price volume profile here. Well, it could trend sideways. I would not be surprised at all. Let me try to just get that back so we can see it. I think it's right there. I would not be surprised at all to see this eventually dump down to here. And at that point, even rebuying it, I would really want to reanalyze the fundamentals of this company, since if their gross margins are still under pressure and their revenue is still not growing, this could be getting into the later life cycle of the company. And at that point, I'm typically not interested in the companies anymore unless they're at really cheap P ratios. And something like Starbucks, which is almost kind of like a retail store, because of just how retail stores work, or restaurant chains, they usually can't adapt as easily once they start losing their competitive moat, which the margins are basically doing. So anyways, you can give me your thoughts. You can, if you've watched the past videos and what I've said in the past, I think I, did give some valuable insights into the stocks. I think my biggest problem was in Charter Communications. I didn't really re-rate it for the lower PE on the lower revenue trend that it basically should have, even though they are buying back a lot of shares and that is going to boost EPS heavily. The fact is the revenue is not growing, and you kind of do have to factor that in and say, hey, this, probably should be trading at a lower PE because of that. But, maybe I'm wrong about that, and the market in the future is going to re-rate it higher. But I think right now, Smuckers SJM is still, I was right about most of the things I said about it, and, positive and negative outcomes that can come. I think it's doing relatively okay, interesting, a much more interesting basically buy now. And my previous analysis on Starbucks there, I did have the caveats for the warning signals to basically get out. And anyways, we'll, see if those actually were good warning signals and if it actually does start dropping in the future. So Anyways, I hope you like that update. I probably will do a few more individual stock analyses along with kind of, updating some of these past videos in batches as 3 as I go forward. Remember to like, share, and subscribe.